picking up, Jack, on a discussion we were having last hour as well, but take a case like Verizon. Not saying the dividend's in any danger, but how do you know when a high dividend is a sign of promise versus a warning sign?
Yeah, it's a double-edged sword because an attractive dividend certainly looks like a great place to be, but sometimes that dividend's too high for a company to sustain.
And so walk us through your methodology. What to you tells you strong dividend, exciting and enticing investment versus an unsustainable one?
Sure. So I started, Kelly, with the S&P 500. And let me just start by saying the S&P 500 generally is in very good shape in terms of dividend and dividend sustainability overall. I also, from that point, took out all of the real estate investment trusts and pipelines because these are structures that are designed to pay out most of their cash flow in dividends anyway. So stripping away there, I looked at companies that have had a difficult time making their last dividend payment. Their payout ratio relative to their earnings was over 100%, or in some cases massive if earnings were negative. So here are some of the names I came up with. First was PP&L. PPL is a regional utility. It earned 117 over the last 12 months, but paid out 166. Its holding company is low investment grade, BBB bond quality, and its equity is rated a C+ on the service that I use. Next is the CME, the CME Group, the exchange, Chicago Mercantile Exchange. This is an interesting one because the CME pays a very small regular dividend, but then has an extremely high special dividend. And so that special dividend that they paid at the end of last year was double what they paid in the 4 quarters. So I suspect while they'll be able to maintain their regular dividend, they probably have the optionality, no pun intended,
right,
to cut back on that special dividend that they reward their holders in the 4th quarter of the year.
So really the numbers, excuse me, Jack, if I might, the numbers are the ratios to look at. It's not that necessarily a high dividend signals danger. I'm looking here at a list, and there's Diamondback with a gaudy almost 11% yield, at least according to this sheet that I'm looking at. But its payout ratio is just 14%, nor does a low dividend necessarily offer you solace or protection.
That's it. I mean, take Ford, for example, which is really probably the most controversial name on my list. They're only paying a 15-cent dividend, but their last 4-quarter earnings was negative 7 cents. So as long as they'll be able to continually crank out positive results, they should be able to cover that 15-cent dividend. But keep in mind, Ford has had a track record of eliminating the dividend. In fact, in 2020, they withheld the dividend for 2 consecutive quarters. So I wouldn't be surprised if things got tough for Ford, that 15 cents would disappear for a little while.
Shepard Smith here. Thanks for watching CNBC on YouTube.